This is what always happens before any major stock market crash. On one side, it seems impossible to predict a crash. On the other side, there are two things that always happen before any major crash. So if you understand how the system works and you understand these two things, you will be able to mathematically predict the next market crash. So in this video, we're going to try to answer a few questions. How does the system works? What are the two things that always happen before any major crash? And what is the state of the current market? Whenever the market grows tremendously, it attracts a lot of people. It's very easy to sit aside and not make money when the stock market is growing tremendously. But not everybody is ready for a stock market crash or for a stock market growth, because not everybody has a lot of capital, not everybody has a lot of cash. So investors, in order to amplify their returns, always rely on debt. They will borrow money and invest in the stock market because that allows them to maximize their returns. Imagine you have just $1,000 and you invested it in the stock market and the market has grown by 10%. You made an extra $100. But if you use a leverage ratio of 10 to 1 and the stock market has grown by 10%, now you made instead of 100%, instead of a 10%, you made 100%. So whenever the stock market grows very fast, investors borrow a lot of money, throw it into the stock market. That leads the market to grow even faster and that amplifies their returns. The question is, what is going to happen if the market slightly drops? What if there is a crack in the market? What if the market falls? In that case, something happens that we call a margin call. This is when your broker is going to tell you the size of your unrealized losses have matched the size of your portfolio. So you either have to deposit cash into your portfolio or account, or you have to exit your position. When the stock market crashes, you don't actually care about that much because the market is going to recover later on and it's just a matter of time. So as a long-term investor, you don't care about this kind of stock market crashes. But if you have leveraged your position, you no longer have that option. Either you have to inject cash into your portfolio to avoid a margin call, or you will have to exit your position because you don't have any other option. These are unrealized losses because the market simply dropped and the stocks are within your portfolio. But if your broker will automatically sell your position, then you have no other option and your stocks have been sold. So what allows you to borrow money and deposit into your account is how liquid the market is. If there is a lot of liquidity in the market and a lot of cash in the market, you can simply borrow against your stocks to back up your account. Then your broker is not going to exit your positions and you will simply wait until the market is going to recover. But if the liquidity is very tight in the market, you don't have that option. So leverage amplifies your wins, but it also amplifies your losses. You're either going to make a lot of money or you will lose a lot of money. You can literally lose the entire size of your portfolio just making a bad move, and the stock market is not going to have any mercy on you. Leverage and liquidity determines how big the crash is going to be. If the stock market crashes, it's not a big deal. So what? It will recover. But if the stock market is heavily over leveraged, then that crash is going to multiply multiple times, which is what leads to a huge stock market crash. And if you look at any major crash throughout the entire history of the stock market, you will see that these two factors, leverage and liquidity, always made the stock market crash a lot worse. Let's take an example of 1929 crash. Between 1921 and 1929, the stock market has grown by 500%. That was one of the fastest growth of stocks in history. And it wasn't because of invention of internet. It wasn't because AI was invented. This growth happened primarily because there was a lot of leverage in the market. Investors could borrow against their stocks. So brokers lent about 75% of the stock's value. If the price of the stock was 100%, you could buy it for just $25 and the rest would be lent by your broker. So you did not need $100 to buy that stock. You could buy it with as little as $25. And if you have $100, why buy one stock when you can buy 4 stocks? The rest of the stocks will be lent to you either by the broker or other financial institutions. So when the price, for example, goes from $100 to $200, on that $25, you just made an extra $100. So that feeling of amplifying your returns lured a lot of people to use leverage and invest in the stock market. But what happens if the stock market corrects itself? What happens if your unrealized losses reaches the size of your portfolio? Suddenly your broker will tell you, listen, either deposit money into your account or we will have to realize your losses and exit your position. Because the United States was on a gold standard back in the days, you could not easily increase liquidity in the market. Where are you going to get more money from? It's a gold standard. You don't have any other option. You can't just print gold out of nowhere. So there was no liquidity in the market. The market was extremely leveraged, and a small crack in the stock market led to one of the biggest stock market crashes and led to the Great Depression. And since then, we haven't actually learned anything. Every single crash followed the exact same pattern. These two factors created every single major stock market crash in the history of the stock market. Back in the year 2000s, the total leverage in the market has reached about $550 billion. So margin debt is basically how leveraged the stock market is. And that $550 billion was about 2.6% of the GDP back in the days. So the total size of leverage in the market was about 2.6% of the entire market. At the same time, liquidity in the market was very tight. So the moment there was some cracks in the stock market, what happened? It led to a domino effect and crushed the entire market, and the stock market was crushed by about like 95% or 85% or something along those lines. The same thing happened back in 2007. The total amount of leverage was about $650 billion, or about 2.5% of the entire GDP. The stock market began to grow, the housing market began to grow, people borrowed money, invested. People borrowed money, invested. Even if people had money, they borrowed against that money and invested in the stock market to maximize their returns. That over-leveraged the market, and as liquidity in the market tightened, even a small crack in the market has led to a biggest drop in the stock market. Now, another interesting case is what happened back in 2021. 2021, or between 2020 and 2021, the stock market was filled with liquidity. The Federal Reserve lowered interest rates to bare minimum, so a lot of cash was going from the Federal Reserve into the stock market or the entire economy. There was very huge liquidity in the market. That money was spent in the stock market, invested in the stock market, and in the stock market kept growing tremendously. When you see the stock market growing so fast, what do? You use leverage. You borrow money against your capital and invest it in the stock market to amplify your returns. And you make a lot of money, and people made astronomical amounts of money. And the stock market reached an all-time high. By 2021, or by the end of 2021, the stock market reached about $1.2 trillion in leverage, or about 4% of the entire GDP. This is the highest leverage ratio to GDP, 4% of the entire GDP. Then the stock market crashed by about 20%. Now the question is, why didn't the stock market crash by 90% like it happened back in 2001? And that's because the market was still very liquid. There was a lot of liquidity in the market. That money came from the Federal Reserve that was injected into the economy. That huge liquidity did not allow the market to crash farther by more than 20%. And now we're witnessing very similar thing, but liquidity is drying up. The total leverage ratio has reached about 3.7% of the entire GDP, or about $1.2 trillion. So we know for a fact that the stock market is over-leveraged. There is a lot of leverage in the market. The next question is how liquid the stock market is, or the economy overall. If the liquidity is very high, even if there is going to be a stock market correction, it will be a correction, it won't be a huge crash. But if liquidity is very tight, then it is going to lead to a huge crash. Now, to understand that, we have to understand how the Federal Reserve works. There is something called repo, repurchase agreements. This is how the Fed injects money into the economy. The Federal Reserve borrows treasury bills from commercial banks, and in exchange, it's going to give them real cash, real money. The current repo rate is about 5.3 to 5.4%. They are slightly higher than the effective interest rates because this is how the Federal Reserve directly injects money into the economy. It creates massive inflation. This is literally the Federal Reserve injecting money directly into the economy, increasing the money supply, which causes massive inflation. So if inflation is 3% and you keep injecting money into the economy, you will continue creating massive inflation. There is also something called reverse repo or reverse repurchase agreements. This is the exact same thing but reverse. The Federal Reserve is taking money out of the economy by providing its treasury bills as a collateral to banks, and banks are parking their money back into the Federal Reserve. The current repo rates are about 4%, which are lower than the previous rates. So imagine you are a central bank, or imagine you are a commercial bank, and the Federal Reserve is providing you with a 4% interest rate, and you have a lot of money. What will you do with that money? You can get a guaranteed return of 4% from the Federal Reserve. That's actually a very good investment offer. So you basically give your money to the Federal Reserve and take treasuries as collaterals and receive 4%. But if you look at the data, you can see that, yes, between 2022 and 2023, most of the money was parked at the Federal Reserve. Overnight, reverse repurchase agreements reached like $2.5 trillion at their peak. The trillions of dollars the Federal Reserve printed in 2020 and 2021 suddenly went back into the hands of the Federal Reserve because the Federal Reserve was on a path of quantitative tightening, which is taking all that liquidity out of the market to prevent inflation from getting out of control when inflation reached about 9%. But since the end of 2023 and 2024, you can see that all of that money left the Federal Reserve and got into the economy back. Because banks realized that it's far better to take that money out of the Fed and lend it to somebody or lend it to the economy because there was so much demand. So banks could essentially make far more money by lending that money to the economy, to people, to the market, than keeping it at the Federal Reserve and getting 4% in interest rate. And it could be for multiple reasons. Reason number one is that nobody believes that inflation is 3%. So if the Fed is providing us with a 4% interest rate, that is absolutely not enough or whatsoever. Basically, banks have taken that money from the Federal Reserve and lent it to the economy. And most of that money ended up in the bond market or the stock market, which explains why the stock market rose dramatically in the last 2 years. And since overnight reverse purchase agreements have reached zero, that means that the stock market or the economy overall is very illiquid. There is a liquidity problem in the market to the point where the Federal Reserve had to inject $15 billion in October of this year into the economy to prevent a financial crisis. There is so little liquidity in the market that the Federal Reserve is intervening and injecting directly money into the economy to prevent a collapse. So what do we have in conclusion? We have a very over-leveraged market at about $1.2 trillion or 3.7% of the GDP, and we have very low liquidity. So even a small drop in the stock market can lead to a financial disaster where it will lead to a huge crash. So a small market drop can lead to margin calls, where investors have to back up their positions with more cash or their positions will be exited. But since there is very tight liquidity in the market, most of those positions will be liquidated, which means that there is going to be massive sell-off in the market, which can lead to a massive crash of the market. And this is the biggest risk that the market is facing right now. This is also one of the reasons that investors such as Warren Buffett are sitting on hundreds of billions of dollars of cash, because they can see these risks happening. And even the Federal Reserve or the chairman of the Fed has acknowledged this risk recently in his last press conference. And these are the two things that always happen before a massive crash. I hope I have oversimplified everything and you understood the point. If you have enjoyed this video, make sure to check the links in the description of this video. That's it for today, guys. Thanks for watching, and I will see you in the next one.